Now, Accumulation Distribution Indicator, or ADL, is a volume-based indicator which was essentially designed to measure underlying supply and demand. It accomplishes this by trying to determine whether traders are actually accumulating, that is buying, or distributing, which is selling. Now let's look at the characteristics of the Accumulation Distribution Indicator. Now, the Accumulation Distribution Indicator gauges supply and demand by looking at where the price closed within the period's range and then multiplying that by volume. The AD indicator is cumulative, meaning one period's value is added or subtracted from the last. A rising AD line helps confirm a rising price trend. A falling AD line helps confirm a price downtrend. If the price is rising but the AD indicator is falling, it signals underlying weakness and a potential decline in price. If the price of an asset is falling but the A&D indicator is rising, it signals the underlying strength and that the price may start to rise. Now let's look at the formula for calculating the accumulation distribution indicator. So first we have to calculate the money flow multiplier, also known as MFM. And here we have given, which is the closing price minus the lowest price of that day, minus the highest and minus the lowest closing price of that day. Then the whole divided by the highest price minus the low price. Next is the money flow volume, and this is calculated by multiplying the money flow multiplier with the volume on the period. So we use this to calculate the accumulation distribution line, which is the previous period's ADL plus the current money flow volume. Now let's see how to calculate. We can start by calculating the multiplier, then note the most recent period's close, high, and the lowest prices to calculate. Use the multiply and the current period's volume to calculate the money flow volume as we have seen in the previous equation. Add the money flow volume to the last accumulation distribution indicator value. For the first calculation, use the money flow volume as the first value. So repeat the process as each period ends, adding or subtracting the new money flow volume to and from the prior total. This gives you the accumulation distribution value. Now, how does this indicator work? When both the price and the accumulation distribution are making higher peaks, the upward trend is confirmed. When both price and the accumulation distribution are making lower peaks, the downward trend is likely to continue. During a trading range, the rising indicator shows that the accumulation may be taking place and hence chances of an upward breakout. During a trading range, the falling accumulation distribution indicator indicates distribution may be taking place and hence there are chances of a downward breakout. When the prices continue to make higher peaks and the indicator fails to make higher peaks, the upward trend is likely to stall or fail. This is called a negative divergence. When the price continues to make lower troughs, but the indicator fails to make lower peaks, the downward trend is likely to stall or fail. This is called a positive divergence. Now let's see which indicator to use based on the volume. You can use the on-balance volume indicator or you could use the accumulation distribution. So let's see the differences between them. The on-balance volume looks at the current closing price and whether it's higher or lower than the previous close. If the closing price is higher, then the period's volume is added. If the closing price is lower, then the period's volume is subtracted. In the accumulation and distribution indicator, it doesn't factor in the previous close and uses a multiplier based on where within the period's range the price closed. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel.